everybody. This is Vija Williams with Place and Ben Kinney Companies and Her Best Life and Empire Building and all sorts of different entities. And also, most of you don't know this, I have an LLC called, well, I'm not going to tell you the name of the LLC, but I have an LLC. I have a couple LLCs because I have started to buy investment properties out of state. Now, for me, out of state means anywhere out of Washington state because I'm in Seattle. And for those of you who have been, stuck around for a while and have followed my wealth building journey, at the age of 48, I decided I had nothing. I had nothing for retirement. I had nothing for my wealth building. And I had a net worth of negative 150,000. And that was 4 years ago. And in the last 4 years, I feel extraordinarily blessed. It's also been a really big focus. And so over the last few months, it's just kind of part of the dominoes that I've been stacking in my own wealth building. The next domino after, it took, like I said, 3.5 years of stabilization and, getting some foundational things down. The next step was buying investment properties. And when you live in an area like Seattle, where our average price, depending on the area, ranges between 800K and 2 million, depending on the neighborhood, it's really hard to make the numbers work. I want to be clear. We have many investors here that disagree with me, and that's great. For what we were trying to do, we couldn't get the numbers to work. So I heard an interview of my good friend, Frank Klesitz, who some of you guys saw. He did the Golden Letter webinar with me, and I'll have Robin drop that link in chat or on the show notes. But his wife, Katy, who I kind of known before, right, Katy? A little bit. I heard her do an interview on a podcast, and that interview was December of 2020, and it changed my life. I heard that interview and literally called Frank within an hour, right away, not an hour. I don't know why I made that up. I didn't wait. I heard that interview because I remember where I was, and I called him. The interview wasn't even over. And I called Frank and I was like, I have to do what you did. So that started this whole thing that I'm on. So I want to introduce you to Katy Klesitz. Hi, Katy.
Hi.
And we're going to walk through your incredible journey. I think your personal journey is fascinating and interesting. That's what drew me in. And then I think we can maybe shift gears and talk about what we're doing together too after that, and just kind of get into some brass tacks, because, my goal, Katy, is that everybody here listening, by the end of this, if this is a success, at least one person goes and does this and presses the start button to do it, right?
That's the hardest part.
Yeah.
Pressing the start button. I mean, how many years did it take you to press the start button?
Well, it was about a year.
Yeah, about a year, but
about 11 months.
Yeah, 11 months. So it's pressing the start button once you have the idea in your head is the hardest part. But some people don't have the idea. So that's what I'm excited to talk about.
Well, let's start at the beginning. Here's what I'd like to start with. I'd like to start with you kind of sharing with everybody what was going on in your life. I guess it would have been 2019 before.
Yeah. So it was 2019. At 2019, I was basically a stay-at-home mom with 2 little ones. And I went to my husband and I was like, here's the deal. Like, I'm losing my mind. Like, my brain's going to mush. Like, I got to do something. I can't, I love my kids. My kids are amazing, but waking up, feeding them every morning, playing with them at the park every morning, taking them to all their activities every morning. I've been doing that constantly for 3.5 years. I'm ready to go back to work. And I was really in a place where I was ready to go back. And I'd had my license before. So I had some, actually how Frank and I met at a Keller Williams conference 10 years ago when I was an agent. And I went back. We lived in California at the time, and I was really like, oh, this will be cool. I'll go get my real estate license. I'll make $30,000, $40,000 a commission. I do 7 or 8, 10 of those deals a year. That's amazing. Cool. That sounds fun. I went through the whole process, got my real estate license in California, passed my test. And then I was like, wait, I don't want to be tied to other people's time. Like, I don't want to like be showing houses on the weekend. I can't travel with like Frank and the kids. I can't go visit my family in Arizona. Like, I don't want to do that. And I was like, but I got to do something. And Frank and I were with a friend who was investing in real estate, and he mentioned to us this whole like BRRRR strategy. And like, I don't consider myself like a dumb person, neither does Frank. I had no idea what the BRRRR strategy was 3 years ago, like 3.5 years ago. No freaking idea. Like, I understood the concept of buying rental properties, but I didn't understand like buying them like at a discount. Like, I didn't understand the process of BRRRR. If that
So
makes
3
sense.
years ago,
Yeah.
you're a stay-at-home mom and
Yeah.
you don't even understand BRRRR. Are we going to explain what BRRRR is to everyone? Or are you going to?
Yeah. So BRRRR is basically you buy a house, you renovate it, you rent it out, you refinance, and then you repeat. And there's a ton of great books on the BRRRR strategy and
The most famous of which is called, well, BRRRR.
BRRRR. Yeah. And the concept behind BRRRR is that you basically kind of go into the house with no money and basically like you leverage your cash well, I guess. And so we buy everything below market, like 20 to 30% below market, minus construction expenses. And then minus construction expenses. So for example, $100,000 house, we make an offer at $70,000. It's going to cost us $20,000 to get it worth 100. So we make them an offer at $50,000 and go in, spend $20,000 on the rehab. I rent it for $1,000 a month. Then I go to my bank and I refinance it. They give me a value of $100,000. And then I get a mortgage on it for $80,000 while I'm making $1,000 a month in rent. And so basically I kind of just keep doing that over and over and over and over again.
So what happens is you're paying yourself back for the cash you put in,
Correct.
ideally, and then you're getting what we call the 1% rule, which is 1% of value, right? So yeah,
and that's an average.
Yeah.
The 1% these days is a little bit of an average, sometimes a little more, sometimes a little less, but it's kind of like that governor. It's kind of like where I try to get close to.
Yeah, exactly. So, okay. So
we were having conversation with our friend. We were at a hotel in Arizona and we were just like, wait, how many houses did you buy last year? He's like, I bought 100. And at the time, Frank and I were, I don't want to say, we were struggling to come up with like, after we're living in freaking California, like my husband has his business where he makes, good money, but it's not like we have all this extra cash lying around after tax. So that's the key, after tax money. So what we were doing is we were saving up 20-30% of after tax money to go put, 20 or 30%, 20 or 30% down on these houses at the time it was Omaha, Nebraska. And we were maybe buying 2 a year, maybe 2 rental properties a year, because we were saving up, we had to save after tax. And the person that we were talking to, we knew we made about the same amount of money as he did, every year. And we're like, wait, how did you do this? And so he went through it, explained it to us, explained what he was doing. And we're like, Frank and I kind of look at each other like, we can do this. And I'm like, I'll go back to work and do it. This sounds fun. I get to like renovate houses. So I kind of glamorized it. I thought it was going to be really like
put on the latest Magnolia Farm.
Oh, HGTV.
So,
yeah. Like HGTV. I was like, this is going to be fun and like so creative.
You're going to do a reality show for me.
Oh, that's kind of like what you think it's going to be like. But basically we took like what he was doing, took Frank's skill set when it came to marketing, took my knowledge when it came to real estate and investing. Because when I did have my license before, I gravitated towards working with investors. It wasn't something I set out to do. It's just, I liked having 1 or 2 clients that bought a crap ton of houses from me rather than having 15, 20 different clients at a time where I was dealing, and it was very number oriented for me as an agent. So it was like, it wasn't emotional, and they were out of state investors. It's cool because you're living in like San Diego and like the, a really great area of San Diego. And you start off this slow journey, but over the years you had amassed like 5-6 houses. Is that right? At the time we were at 15. So it had taken us 10 years to get 15.
Okay. 10 years. That's okay.
Yeah. So
So
it's taken
then
us 10 years to get 15.
by the time, so when 2019 happened, you kind of had those 15 for a while.
And that was, we'd had those 15. I think I bought one. I think I bought two in 2019 or 2018, or three. So I'd bought three in the last probably like 18 months. And I will tell you, because I had purchased those, I had a lot of equity in those houses, and I was able, and that's how we got started. So we didn't have cash going into this business. Like we were like, the cash we spent starting this business was, we spent $10,000 on letters for our first batch of letters. And that's what we spent of cold hard cash. What we, how we were able to purchase our first house was with a hard money loan. But after we'd kind of started doing that, we're like, oh my gosh, these freaking letters work and I have deals. I got to figure out how to pay for them. And part of the way I paid for them was we found a bank that took a chance on us, basically, didn't make us refinance those 15 houses, but gave us a second, like a line of credit against the equity we had in those houses. And it was basically kind of an unconditional line of credit where I didn't have to get deeds of trust secured against those houses. It was just like, I could call up and be like, hey, I need $100,000 for a house. They're like, wire it. And that's how we started. We started with a line of credit, with a $500,000 line of credit.
So I do want to talk about financing in a bit, because that's like a big, huge topic. And it's the drunk monkey talk in people's heads right now, is they're thinking, I can't do this. And so let's silo that. Everybody, don't worry. We're going to talk about that. Of options. But I want to keep going with Katy's story, because it's a good, so you're in 2019, going into 2020 though. And you hear this guy did like 100 in a year. And then what happened next?
I think so. It was the end of 2019. I think I somehow managed to buy 15 in like 4 months using this, this thing. But what actually happened is I had some friends that were like, what are you doing? You know what I mean? Like, how can you do this for us? And so basically a couple of us got together and we were able to kind of like cost share. So cost share in our infrastructure. So we ended up hiring, like, I now have ISAs. I think I have a staff of 25 people now that work, like a stay-at-home mom that has like 25 people that work for me, helping me buy houses across the country.
Well, you're building an empire is what you're doing.
It doesn't even seem like that.
That's how it doesn't ever seem like that. So so you started helping other people do the same, right? Yeah.
So we set up some partnerships, and because keep in mind, like Frank and I didn't have the money, to like build this infrastructure to like do this at a massive scale. So we kind of, all of us that started doing this together, we kind of had the conversation, like we kind of missed the boat in 2008, 2009, 2010. We were too young, you know what I mean? And didn't have the money or the money and also the experience to know what we were missing out on. And so none of us wanted to miss out on that next opportunity. So we basically figured out how to all come together. We cost share in our infrastructure, and my staff at infrastructure helps us buy in lots of different states.
And so you bought how many in 2020?
Oh, I knew you were going to ask me that question. I don't know. I know now we own, I think, about 180 properties.
That's I mean, so it's, at the time of this taping, it's March 2022. Yeah. And so, and
that doesn't include the multifamily we started buying. Like, I have to go back.
Yeah. Why would it?
I'm like, oh, you could do it with single family. Why not try it with multifamily? Which has been a disaster. But now we've learned, and it's not so bad now.
And so, how much money are you bringing in every month with like gross rental income? Not even NOI, just like gross.
No, that's a great question. So, how it actually should work, but I say should, with a grain of salt. So I have it separated out into a bunch of LLCs, but I think we should be getting like about 180 once everything we have right now is stabilized. So that's with a grain of salt. And we're not there right now because I have 25 projects under construction. And then I have rental assistance that I'm waiting on and people that are getting evicted. But if the portfolio was completely stabilized, we'd be getting about 180. But the cool part about the portfolio is, I think, if we're for one of the LLCs, for example, I think we have loans of about 9 million, but it's worth about 14.
Yeah.
So it's a balance sheet activity. You know what I mean? I'm not.
Oh yeah, completely.
And that's the thing I think people need to understand when doing this strategy. You're not going to make a lot of money right now just by doing rentals. Like if you need to make money, you're going to have to wholesale, you're going to have to do flips. Like the rentals it's a long-term game. And that's our thing. My goal is I want $1 million in retirement income in 15 years. Once all my notes are paid off and everything's done, I want $1 million coming in a year, which just from my properties. And if once everything's paid off, we've hit that plus more.
Are you going to accelerate payoff on that because I'm assuming they're all on 30-year, they're probably not all on 30
They're
years,
not on,
actually.
they're not on, this is a whole I could do a whole freaking thing on financing. The best loans to get, if you can get them and lock them in for 30 years, that's amazing. The challenge is after you have your first 10 that are backed by Fannie and Freddie, that you can get conventional loans on with basically the 20% down, and it's a lower interest rate and it's a 30-year. After 10, you got to almost go commercial, or you have to start working with bigger banks that do portfolio type loans. And I've found some that'll lock me in for 5 years, 7 years, 10 years, 20 years. And some of them can be adjustable rate. So kind of my full-time job now is kind of managing that side of the business and making sure that I'm getting rid of assets that aren't performing or pulling money out where we can to keep the machine moving. And playing with mortgages constantly. That's a whole different. Out of that
180 you have, how many of those are single family ish?
180, you're probably single family and duplexes. So I group duplexes into my single family, or basically anything under a fourplex because of the financing. So anything a 1 to 4, you can get traditional financing on basically, or conventional. Anything above that, I consider multifamily. So
exactly.
So we have a couple multifamily, but the 180 is, and that would include, I think, stuff that we have under contract as of today that we're going to close on by the end of the month.
Okay. So that's a really, really good overview. I mean, you basically went from, stay-at-home mom to 180 units. And if any of you—
and during COVID too, by the way, during COVID, all the banking stopped for 6 months. So we stopped for 6, I couldn't get a loan. I couldn't do anything. I couldn't refinance. I couldn't pay contractors. So we had 6 months of nothernness.
Oh my gosh, I totally forgot about that. So here's what I just before we kind of move on down the road here, I want to share with everyone, if you spend any time with Katy, and I do, you'll be hanging out with Katy. Hold on, I'm going to take this call. She sounds like an investment banker at this point. All of her calls are it's crazy. It's crazy. I didn't really know you very well anyway before all of this, but I have a feeling there's a lot of people in your life that are really proud of you because, 3 years ago, you were a different person. I
didn't know what an adjustable rate mortgage actually meant. Do you know what I mean?
Yes.
And I was like, wait, what do you mean origination fees? I had been a real estate agent, but I had worked with cash buyers all the time. I didn't work with loans and financing. And I didn't know what I didn't know. I had to go out and educate myself. And I also asked questions. I found people willing to teach me, and I would call up a banker and be like, here's the deal. I have a deal. Help me. And they'd be like, oh, we could structure it this way, or let's look at it this way. And I talked to so many people. That's what I just encourage everyone to do. Anyone, in investments, that's doing this, talk to them, ask questions. And it's so I didn't have a problem being I don't know what I don't know. Yeah. And then sometimes I faked it. You know, like there were times I got on the phone with bankers. I'm like, yeah, I know exactly what you're talking about as I'm Googling.
And you're like, I've done that too, by the way. But then by the second one, you know what they're going to ask. And so here's what I want to, like, before we move on to the next one. And I think we should dive deeper into financing, because everyone's going to ask. I've already started to get some messages. So we will dive deeper into financing. But what I want you to know is that this happens more organically than we're making it sound. So you don't have to know. I did not know any of this. I think I'm on my, I don't know, 8th acquisition in like 3 months.
Yeah.
Something like that.
You're doing incredible. I'm so proud of you.
Yeah. Thank you. Well, our goal was 24 this year. I have an appetite for more. I just don't know. It actually depends on financing, right?
You're right.
Like I took to this like white on rice. Like this is great. Like I wasn't sure either how I would do. So I thought, well, let's dip our toe in and see. And the other comment I'll make about this is that, you know, because I think it's the unique perspective I bring to these conversations, is that this is a really good spouse activity. Both Katy and Frank, and then Ben and I, you know, it's been a really good for both of our marriages, I think, because it's let each spouse shine at what they're good at.
Yeah.
And this has really empowered my husband's amazing at this. He's a way better, as it turns out, operator. He was already a property manager here. And so we're like, oh, it's his whole of his software, his systems, he can still property manage it out of state. We just have to get a ground crew. We just have to have, you know, our contractors, and we have a full-time employee that can go. So it's just been really great, because it's really become, we love it. It's really, we would both like this to be his full-time job, both of us. Yeah. And so it's something to think about.
This was something I started part-time. Like I wasn't supposed to be in this role. Yeah. Like I was like, oh, let's just acquire a few and I'll handle it myself. And it started working better than any of us could have expected. The first letter Frank dropped, he sent it to my freaking cell phone. I was like Russian roulette answering my call. I was at Legoland with the kids, like, and I was like, oh, oh my God. Like, and so that's when we decided we needed ISAs, because I'm like, I'm not answering like all these calls at all hours of the day when I'm still trying to like juggle, you know, being a mom. But through the process and starting it, we got to problem solve a lot of this stuff together. And that's how we set up all of our systems. We're like, oh, if that doesn't work, new system, you know? I
mean, it's so incredible. So, okay. So what I want to do is I want to kind of walk through. So that's the overview. Yeah. Now what I want to do is I want to kind of start thin slicing it. So let's start with acquisition, because you've talked a lot about letters. Our audience has seen Frank a few times. Of course, you can always use real estate agents. Two of ours are with real estate agents, and that's great. But let's talk about how to get these off market, Katy. Let's talk about the letters and the general, just a broad doesn't have to be detailed, but you know, a broad overview of what our acquisition system looks like. And by the way, we are working with Katy and Frank in Tulsa, so that they're our partners in Tulsa. So we're part of their group.
Yeah. So basically, we've tried everything when it comes to direct mail and doing really niche marketing, like being like, oh, we want these zip codes and these size houses, and none of that works. Like the best thing we do, you have to be consistent with your mailers. You have to blanket drop it. So like, for example, we do about 10,000 letters a month to anyone in the county that has lived in their house for, 7 to 10 years, depending on what that is, under the median price point. That's it. That's all. Like, and we send out a letter, and it's consistency. So we hit this, like we do hit a lot of the same people over and over and over, and they may not call us for a year, or they call us and say, hey, like, we're not ready yet. And then we have ISAs that are constantly nurturing anyone that's ever called in and, we have a CRM. So that's been our bread and butter. We like the direct mail is what has worked for us great. We've tried some Facebook stuff. We've gotten a few things here and there, but we tried pay-per-click and got a few things here and there. The challenge with pay-per-click for us was you're talking to people that have clicked on 9 different websites. Like, you know what I mean? Like, I don't want to fight. I'm not going to go, we're not that's just not my personality to go out and fight for the business and convince them to sell to me. We like direct mail because it's kind of a warm lead. Like they call you, like you're the only one they are talking to.
Yeah.
And it gives you an opportunity to build a relationship with them. And I mean, I have people that we mailed in 2019 that are selling us houses now.
Wow. I mean, it is more expensive. There's pros and cons. Like you have to be committed. Like it's expensive. I mean, it is about, I think it was $10,000 or $15,000 our first one. And I think our second's like 10 or something, but yeah, it's not cheap.
You just have to budget for it. I mean, like
budget.
So we basically have come up with the number that we can spend about $3,000 to get a deal that makes sense to us. So if we get 3 deals after spending, you know, 10,000 or 4 deals after spending $10,000 or $12,000, it makes sense. And you just have to make sure that as you're doing that, you're paying back like your marketing budget. So it keeps moving.
It's effectively your cost of goods sold, right? You have kind of that, your employee, the bonus of your, you know, your acquisitions manager, or whatever you're calling him. So if it's say sort of $5,000.
So this is one of the, and this is one of the reasons why, like, so on $100,000 house, I take a 30% discount, not a 20% discount, because there's that 10% in there that you have to pay, you know, like basically pay back your marketing budget. You have to pay closing costs. You have to pay, we pay an estimator on the ground, call it a commission. Our estimators are not licensed. They're employees of us and are representatives of us in our company. And there's always other stuff in there, you know, like sometimes you have to pay back taxes, or it just gives you some wiggle room. Insurance, you have to pay insurance. So that's why the BRRRR strategy technically is being able to refinance out at 80%. So, but we do 70 because there's all these expenses that just, that are outside of construction and acquisition of the house.
Yeah, that's right. So basically we do a letter writing campaign, and then our what do we call, Cindy, what is
estimator?
Estimator. Okay. I'm like
boots on the ground estimator.
Boots on the ground.
We used to call acquisition agent, but I like
so
estimator.
Your ISA department is fielding the calls, and they're trained to convert them, and then they set appointments for her, and then she goes and meets the homeowner.
Yep. And she just gathers information for the most part. So she actually has a phone call with the homeowner ahead of time to find out, like, to kind of get a feel for what she's walking into. Like on a scale from 1 to 10, how do you rate your house? An 8, you know, or a 2. I want all the 2s. I don't want the 8s. You know, like, because the 8s can sell their house, you know, house traditionally probably and make retail. More money, get retail. But like, have you done any upgrades? And she kind of does like a pre-interview so that she pulls comps before she goes. So she kind of knows, like, she pulls comparable properties based off of her pre-interview. And then she goes out to the house and gathers video. And her job actually really is to just build rapport with the seller. Like, hey, what is your problem? How can we help you solve it? And we kind of like to position ourselves more as consultants. Like, we do not come in as investors. We come in as like, hey, how do we help? Like, we're one of your options. We're not your only option. And we're really transparent about that. And we talk to our sellers about, hey, if you put it on the market based on these comps, this is what you could probably get. But keep in mind, you know, like, it's probably going to be 45 to 60 days to close. Like, an agent's going to take 6% of the commission. You're going to have repairs. By the way, in its current condition, you can't get an FHA buyer. And what does that mean? You know, and so we basically, we give them the option of refinancing. We'll introduce them to contractors. We'll introduce them to an agent that can help them. And then we'll be one of their offers on the houses. And something like our thing that's worked really, really well for us is building a rapport with the seller and being someone that they can trust.
Yeah.
And I can't tell you how many times they're like, well, this investor offered me $15,000 more. And we're like, then take it. If he's doing that, take it. About 2 months later, we'll get a phone call and be like, you were right. There's no way an investor was going to pay $15,000. He just came back and asked for the price you gave us.
Yeah.
And they'll give us the deal based on that.
Yeah. And a good acquisition person will tell that story to like prevent that objection.
Yeah, exactly.
And helps with that. Yeah.
And so we have daily acquisition meetings with all of our estimators and all of the markets to kind of teach and coach and train them on how to handle that and handle those objections.
Well, yeah. And so you get it in contract and assign it to your partner. Fun fact, everybody. Fun fact, go ahead and research if your state that you want to do this in actually allows you to wholesale. That's been fun.
Oh yeah. So we are not wholesalers. Like
No.
we're not wholesalers, but what we were doing is because the estimators were employed like under us, we were writing the contracts under our company name and then being like, oh, we'll just assign it to our other LLC.
And
no
or
big deal.
Yeah.
And or assigned to like one of our LLCs. We're not going out and making money, but we were just going to change the name on the contract. Well, there's certain states that's really not allowed in. Oops. So we had to go
Oklahoma
back
people.
Yeah, Oklahoma. So we had to go back and figure that out. So when you're actually purchasing houses, like writing it under the LLC you're going to close in is a big deal in Oklahoma. In Nebraska. Yeah, in Nebraska and Texas.
That walking in. Yeah.
Nebraska and Texas, it doesn't freaking matter. They're like, what? This day of closing, I could call up and be like, hey, can you put it in this LLC instead?
It's so funny. Well, anything goes in Texas. Like Texas is like, whatever you want. But yeah. So,
I had to learn the difference between like an abstract title state.
Hi, Oklahoma. Can we talk about, so did I. Fun fact, there are 2 states in the US that are abstract title states. And Oklahoma, of course, is one of them.
So which means your closings are going to take longer.
Oh. Don't even just Google that. Like I can't even talk about it. But here's what I do know. Here's the good news. The good news is it doesn't matter. You figure it out and we're fine. And we're continuing to do it. And we love our market. We love Tulsa. And it's like, who cares? Like, don't worry about it. That's the thing. Like we can scare you, or you can just, I don't know, I
mean, you just like you roll with the punches. You're like, oops, didn't know that. So I guess that's kind of like my like message, I guess, to like a lot of people is I didn't know anything. Like I knew nothing. Like I feel like I knew nothing. Like I knew what a real estate contract was. And I knew like maybe this was a good investment just based off of looking at it. But I just didn't doing where I'm at now. Like I didn't know. And I had to just figure it out. And thank God I had people in my life that had kind of been doing it that I could ask, and be like, hey, and some of them were like, I don't know.
So basically, so you buy the house, the short version of it is, and then you do have to find contractors in that area. Cause we're talking about out of state investing.
So
our story, we found ours driving around.
Exactly. But the big thing for us in something, if you're investing out of state, and this is something that I made a giant mistake on, is I trusted the contractor I hired and was paying to actually give me real updates. And I'm not saying most contractors aren't legit, but there is a handful of them out there that are not. So this is where, when you're investing out of state, you need to have someone like on payroll that you trust, that is loyal to you and not to the contractor or to the property manager. Even like you need someone that is loyal to you as the owner of that house, and you pay them either on contract or hourly to go out and get videos constantly. And right now, like for example, Vija, you're using your estimator because it's not like you don't have like 50 houses that she has to go check on right now. So she can kind of be jack of all trades.
Yeah. And she can also show it to
potential tenants. But she gets videos, she or he, whoever gets videos of these houses while the contractors are working on them every other day. Do
you want to get depressed? Our contractor sends him. He's so good. Like we lucked out so much.
But still, like I had a contractor that was sending me videos, but he was sending videos at angles where you couldn't see everything. Oh. So my point being is, even if you have a contractor that sends you videos, make sure the person, like I could tell you some stories. This one real quick. He took a picture of the pool that was supposed to be filled in, and he literally had the photo like at the perfect angle that, hi honey.
We have a co-host.
You don't feel good. Can you go sit with daddy or with Aaliyah for a minute? And I'll be there in a minute. I know she looks a little pale. Okay, go play Minecraft.
You want to be on our webinar?
I said, go play Minecraft. She's magically better. But so he literally took the photo. Like my listing agent went out there the next day, but he took the photo and it showed the sod laid down in the grass, but there was a little hill. And on the other side of the hill, there was still a 12-foot pool that was dug. He didn't fill in the freaking pool, but he wanted to get paid. And I was like, yeah, I'll pay you. Like, just send me a photo of it being done. And he literally angled the camera.
Unbelievable.
And my listing agent goes out there the next day. He's like, Katy, I'm here getting photos and the pool's not filled in. I'm like, what? So, and I'm not saying most people are like that, like, but like trust, but verify. Like, that's something that's changed. Like, I used to see the world completely through rose-colored glasses. And I used to be like, oh, give them the benefit of the doubt. And they're like, oh, you know, they're just having a hard time, or they'll be honest. And the thing with contractors is they do really, really good for your first 4 or 5 jobs. And then when you start to be a little lax, that's when they start cutting corners.
Okay, that's good to know.
That is a big thing to pay attention to.
Okay, that's good to
with
know.
Contractors, and make sure whoever your trustworthy person is at least checking on them at least once a week. Yeah, to make sure. And before you issue payments, especially from being, you know, if you're out of state, like you need a video. If they want a payment for flooring, like your estimator is out there checking out the flooring and making sure it's laid properly. You know what I mean? Like making sure the transitions are done. It's little things like that start to add up if they don't get done when they're supposed to get done. Yeah, that's really, really good. So you fix it up and then, you know, rent it. And then ideally you would refinance and effectively pay yourself back your cash in, right? Yes. And that's how it works most of the time. Sometimes we get more, sometimes we get less, but it kind of is out. And even like some of the real estate's gone insane right now. Like even some of the properties I bought in 2019 that I refinanced early 2020, I'm looking at because the freaking equity, my rents went skyrocketed, my equity's high, and I can pull the cash out to ever had to use specific like fix and flips lines of credit because I started with hard money. Hard money for me was easier because I had those relationships. I had a relationship with, it was actually one of Frank's clients who they were actually in San Diego at a workshop that Frank did when like the first weekend I ever went to visit Frank before we got married and stuff. So they've known us a really long time and they're amazing humans. And we kind of told them what they were doing and they'd always wanted to be in business with us, but we couldn't quite figure it out. And they're like, well, what do you need? And we're like, I need money. And it was like the scariest thing in the world to ask someone, hey, like I need $150,000 to buy this house to purchase the house and the renovations. And they were like, done. I was like, wait, what are you, what? I've never done this before. And they're like, you'll figure it out. It's fine. Like they had more confidence in me even than I did. And I was so afraid. To ask, but it was funny. Once I asked, then I was like, actually, they're making a lot of money off of me too. You know, like it's a win. It's a win for them and a win for me. So hard money was the easiest for me. Okay. There's a lot of like lines of credit that you can get, with like there's Lima Capital, CoreVest, Finance of America, where basically you have to put 10 to 20% down and then they'll fund the rest of it for you. So they're kind of like bridge loan lines. Yeah, like credit. They still send an appraiser out and stuff. Yeah. So it's kind of weird. Like it's not like it's not an unconditional. Right, it's not an unconditional line of credit. It's not like a credit card. Yeah, it's not like a credit card. It takes 30 to 45 days typically sometimes because they have to get an appraisal. If it's the first one you're doing with them, it's going to take even longer because they have to vet you and make sure you're credit worthy. But once you start working with them, they get easier. Yeah. And if you can go really deep on a relationship like that and it works for you, like freaking do it. And that's also, if you have $100,000 or $200,000 in cash, that's a really good way to go. Because you can leverage that $200,000. That $200,000 is the 10% down that you need. That's $2 million worth of real estate you can buy. I mean, if the numbers all work out, you're probably closer to 1.5 because you're going to make mistakes and have issues and appraisals aren't going to come back where you want them to. But I would say you can leverage, that $100,000. For us at the time, like I didn't even have that $100,000 to leverage. You know what I mean? Like, so that's why I did hard money, and my hard money lender did 100% of the purchase and 100% of construction. Like that's a sweetheart deal. Yeah. But if you have people in your life that'll do that with you, like do that with them, or maybe have them do the cash and go 50-50.
Well, the cool thing with
I'll do all the
working with
work.
you
Yeah.
is like you're just bringing us hard money. Like you're it's incredible. Like partnering with you, we're just leveraging your relationships is what we're doing.
Yeah,
you're just bringing us all that hard money. We're like, yeah, we'll take it. We'll take it.
Yeah.
I think we're up to 2 or 3 now. Yeah.
Yeah. So there's options, but I think the easiest, for people that are nervous about this or nervous about over leveraging themselves, buy a house that's built after 2000 that needs some paint and flooring in a decent neighborhood and put 20% down.
That's like, well, that's our first 3, we put 25% down in Tulsa, and they were kind of retail, like they were, in the higher end of our range, like 150,000. They were a little older, but super nice. They like they're going to appreciate.
Correct.
We're just renting our second one. Like that's what we did.
And that's when I tell people, I'm like, just get started, just do something because don't forget, as long as you have the income, and that's the big thing, especially with real estate agents. Yes. I'm like, oh my God, don't write off all your income. You need to show that you're making money so you can go get these loans in order to build your portfolio. And that's what's happens with a lot of real estate agents. They run everything through the business and they show that they made $40,000 last year. And I'm like, you're never going to be able to get a freaking loan. You're never going to get a freaking loan.
I will tell you guys, that is actually something we need to talk about. So that is a problem because I was doing that and I have to show income and, your tax bills going up.
But buying real estate helps you offset that.
It'll help offset it. And we're not even going to talk about accelerated depreciation. I just don't want to go down that funny trail. I can't, there's too much, but there are different things you can do with this to really help with your tax bill. So, it's just, you're remargining almost your whole financial picture when you do this, admittedly. Right.
Yeah. And obviously, and I'm not an expert on this. I definitely recommend everyone talking to your CPA, with your personal situation and what you should or shouldn't do. Your CPA might say, actually take that cash and pay for a house cash and have a remodel project going on when you're switching tax years, because that can show as a loss. There's lots of nuances. So obviously always check with your CPA on this, but the big thing is being able to, if you can utilize those first 10, and those first 10 loans and lock those rates in for 30 years, especially right now, even though rates went up a little bit, they're still historically low.
They're still good.
Lock it in for 30 years. And who cares if it takes you 2 years to buy 2 and 3 and 4. In 5 years, imagine the equity you're going to have in those 5 properties that you just bought. And then you can go pull cash out of those to continue moving. You just have to buy
here's the thing. 100%. And here's the other thing that I have learned, guys, is that you sometimes, to get these lines of credit, you need 5 or 6 already. You need to have a rental, and they can be new you don't have to sort of have had them for years or two, but if you're not sure, if you're not sure if you have the stomach for this, then do what Katy said. And 2 or 3 years from now, okay, you have 4, 5, or 6. Then if you want to accelerate it from then, you've got everything you need really to get to access any of these financing options we're talking about, even hard money.
That's a great point. It's being Joe Schmo off the streets. So literally one of my partners, one of the number 1 agents in the country, I went to go get a refinance with him, for him to sign on the refinance. And he only owned 2 properties at the time. They're he doesn't have enough real estate experience for us to refinance his property. What? I was like, what are you talking about? And it was hysterical. We had to go round and round with them, but I will also tell you, when it comes to financing, banking relationships are so important. And one of my other full-time jobs is working with commercial lenders at small local banks. So wherever you decide you want to invest, open up a bank account at a small local bank,
and meet with them in person, because they have to note in their file that they have a relationship with you.
Yes. So that's a difference. I didn't know.
I know.
I didn't know
either.
I had a bank that dropped me. Yeah. Dropped me and was like, we can't work with you anymore. And I was like, what are you talking about? And they're like, well, we're a relationship-based bank. And since you don't live in the state, it's considered online banking. that now that and it was like, what are you talking about? So they like I had to move my loans to different banks. But if you meet them, and I had a banker once go, can you meet me for lunch on Friday at 5? I was like, I will be there. I flew to freaking Omaha, had dinner, talked to him. And because now we had a face-to-face relationship, it was considered a relationship, and these are not, I'm talking about, you are not talking about freaking Chase and Bank of America.
No.
Like, you're not going to get the good deals with them per se, and they're not going to take chances on you. But the small local banks, and I like assets when they're managing assets under about 200 million. Like, so if you can find out what the bank is managing, about 200 million, they have a little bit more like ability to work.
Is this part of their Community Reinvestment Act as well? Because some of these neighborhoods, yeah, I would think so. So I think so the small local banks are really important, and like, go figure, like, I did not know this. City. You have to meet with them. So, okay. So there's different ways to get financing. The bottom line is there are different ways to get financing to do this.
If you have a good deal, you'll find the money.
You'll find the money. We so far have. And, I mean, most people have people in their life, if they're in real estate, that, that'll help them. I agree. That'll at least partner with them, right?
At least, and that's another thing. If you don't have the stomach or the money or the ability to do this on your own, or even so what makes what I'm able to do really awesome is Frank is incredibly creditworthy. You know what I mean? Like with his business and his income and its consistent revenue, you know what I mean? Like banks are like, cool, like he's good. So because of his creditworthiness, that's how we're able to get these loans. So if you don't have that creditworthiness, partner with someone, go in 50-50, be like, I'll do all the freaking work. I'll find you the deal, and you just bring the money and help them build their portfolio. I've known so many people, and I've run into so many people that have become millionaires doing that with none of their own money.
And then you pay them back over time. So there's different ways you can pay out your part of that 50-50 equity, right? Like if they're fronting the money, you can then, there's a lot of ways that you can
There's lots of ways to structure it. And that's the cool thing. It's your business, and it's these deals, like, you guys get to figure out how to structure them together.
So what stops people from getting started? I'm not talking about people who don't want to do this. There's some people listening who are like, this is not for me. There are a lot of people listening who are like getting excited right now, like I was when I first heard you, but why won't they do it? What's typically stopping them from diving in?
I think they second guess themselves on, is this a good deal? What's happening with the market? Can I get the money? And something I've learned is, and I've made mistakes on deals, you guys. I bought a deal. I can't even tell you the horror stories on some of the deals that I bought. And I'm like, that's just going to sit there for 3 months while I lick my wounds and figure out what to freaking do with it. And something will come to me in a sense where I'm like, oh, I can sell that. I can turn it to an Airbnb. I find a buyer for it, something, you know what I mean? Like, you'll figure it out. I always am like, do I have enough money to make the payment every month? And if I do, I'll figure it out. It's an asset. The thing is, it's an asset. And if you can hold on long enough in real estate, time will solve all problems. Like, and that's my biggest piece of advice. Like, I bought some stuff in 2019. I had no business buying in 2019. I screwed up, made awful decisions, but I held on to it. I was like, you know what? I can make the payments. I can figure it out. We'll deal with it later. Like, I'll deal with it later or whatever. And I got tenants in there just to make the payments. Right. And I'm like, oh God, it needs a new roof. Oh, frick. I'm going to have to do that at some point in time. I kind of prayed for a hailstorm.
Yeah. So insurance will do it.
I'm like, I prayed for a hailstorm. I remember being like, I don't have $10,000 for a roof, and praying for hailstorms. But time will solve all problems in real estate. Like, if you can hold on long enough, or you have a partner. So I consider Frank my partner that has the cash and the ability to just make sure those payments get made. And hopefully their interest, maybe you're at interest only payments. Like, the interest only payments are getting made every month. Like, you'll figure it out.
Yeah.
You know what I mean?
Right.
And there's always, there's been deals where I'm like, I don't have the money for this, so I'm going to partner with someone on it, and they're going to put the rest of the money in. And I'd rather own 50% of something than 0% of nothing. Like, I'll give away half my equity on that house just to finish the damn thing.
Yeah.
So
Yeah, that's kind of what we came to. We talked
Yeah.
about partnering or not partnering, and and we're at this point we haven't partnered. We have offers of partners, and I was like, well, I think it comes down to, do we want to buy 100 with a partner or like maybe 25 on our own? And I think I want 100 with a partner for a variety of reasons.
You can do
It's more
both.
equity. It cushions it for all of us.
Yeah.
Makes
But you
more
can do
sense.
both. Like, so you can
Yeah.
have your LLC where you own, so that's what I do. I have an
Yeah.
LLC where I own 100% of everything. And then
Yeah.
I have like 7 or 8 where I own 20%. But my model's a little different because everyone cost shares in my staff. So
Yeah.
I get paid monthly. I get paid monthly to manage the staff and keep it going. And like, I don't make any money now. I'm looking to make money down the road. I keep everything in the business. And so I think there's just different ways. There's different ways to structure it.
Oh yeah, totally. I mean, totally. I am getting some questions. So when, I just lost it. Do you ever do that?
Yeah.
Do you ever do that? My brain was just exploding. So I'm like, wait, what was my one?
Well, that's what happens when you and I start talking. It's like all this.
I know. Whenever I see Katie, I'm like, it's just nonstop. I just completely lost my question. That's never happened to me on this. Oh, that's so funny.
That's all right. It'll come to you.
It's been a long day.
It's been a long day.
I do. What do I get questions on? I think I get a lot of questions on refinance, on the refinance part. And I can't answer that yet because we haven't gone through that. It's only been 90 days for us. But what I am noticing is a lot of these line of credit companies that we're talking to now are offering refinance opportunities.
You got to pay attention to those, because if you can keep it all in-house, a lot of times they want to, keep it in-house. They want to keep it in-house, but you got to pay attention to the rates. So, and they're probably only going to give you, some of them are going to give you 5 years, maybe 7. I know Finance of America has a portfolio loan package where if you refinance a bunch of them, they'll lock you in for, I think, 20 or 30 years. And the rate's not awful, but it's not great compared to what you can get at the small local banks. But the refinance, something you have to think about is most banks want a 6-month seasoning period. And that typically means from like the date of purchase to the date of refinance. Mm-hmm. And so if you do have short-term money, or you're getting short-term money on like hard money loan, or you're getting a line of credit, make sure that your terms, you have at least 12 months to pay it back. Don't write your notes for shorter than that, just because I will tell you, I worked on a refinance for 8 months in Texas. It was an 8-month refinance. Like from the time and that's not from when I purchased the houses, that's from when I started the refinance, because there were so many issues with appraisals and just appraisals and how they wanted our business documents structured and signatures and payoffs. And it was a pain, but yeah, that's a piece of advice that I didn't know at the beginning. Because ideally you find a small local bank that'll do it. I have a bank in Omaha that literally I show them, because I have a track record. I've proven that I can do this.
Yeah, now you do, but at the beginning,
So I can refinance in about 3 months. And
I got a question on, how do you find property managers out of the area, out of state?
That's a great question. We manage everything ourselves. So we had a bad experience with property managers. We owned our first 15, and Frank is Mr. I'm going to set up systems and processes and do it all myself. Mm-hmm. Not everyone has that bandwidth that Frank does. You get referrals and recommendations, and call agents up that have mm-hmm. A lot of the people listening to this podcast are agents, you know what I mean? And they have agents in other cities that they know. Call up agents and be like, who would you recommend your clients use? Yeah. But I would also be really careful when you're looking at a property manager. You want someone that's that's a flat fee, and they don't upcharge anything when it comes to maintenance. You pay, if they hire a plumber, you pay the plumber what you paid the plumber. You know what I mean? Yeah. They aren't upcharging, because you can get killed. So you can get killed on that. You can also get killed on lease re-signing fees. So pay attention to that. Yeah. A lot of property managers are like, oh, well, we want $500 to re-sign a lease. I'm like, it's the same freaking tenant. You're getting a paper signed and they've been there for 3 years. No. Yeah. You know what I mean? So just make sure you read the fine print. Depending on your portfolio volume, like if you have say you have 25 houses, I think 6% is very fair, very fair. If you have a couple houses, probably more like 10%.
Yeah.
And then you also have to pay attention, the property manager will pay attention to the condition of the houses. So if these are nice houses in nice areas, they don't have to deal with a lot of calls. You'll probably get a bit of a better rate, but it'll get more expensive the older the homes and the crappier the tenants.
Yeah. I remember the question that that I was going to ask you. I know the answer, but I'm going to ask you so that everyone else can hear the answer. And that is LLCs. I had someone earlier. I didn't address it earlier in the podcast, and I remembered it now. How many houses or what type of volume in your portfolio do you put in an LLC before you then diversify and open a new LLC?
Well, how it's supposed to work. Like, let's be real, because how it's supposed to work is I'd like to have no more than 25. But the challenge with a lot of that is when you're buying these houses on lines of credit, the lines of credit are in certain LLC names or in personal names. So it's a constant kind of dance. Yeah. So basically what I have to do, I buy a lot of my stuff in one LLC. And then once I get it stabilized, I then quit claim it once we have a loan on it or whatever, then I'll go and quit claim it into another LLC. That is not something I have stayed on top of. And that's a big risk for me. But I would say at my level, like I would do no more than 20, 25.
Well, here's the thing. You say 20 or 25, but the volume was at 2.5 million in real estate.
Yeah, at least.
Okay. Yeah. So, cause some of you are buying like $300,000 units or whatever it is, but
it's kind of your personal risk tolerance.
Yeah.
And then also you have to make sure that you're really up on your accounting and everything goes through different LLCs, because otherwise it's piercing the corporate veil. And like,
well, the point of an LLC, everybody, just in case you're wondering why, is it's to help you, your exposure to liability. So if you get sued, potentially the assets in that particular LLC will be at risk, depending, right? So you don't want to have one LLC with all of your homes. It's also not realistic at the volume we're talking about to have one LLC per home. I've also heard people do that.
So we did that originally, and then I'm filing 10 for the 10 rentals I had. So this is when we only had 10. Frank was like super risk adverse at the time, and we had an LLC for every house, and the tax returns at the time were like eating up all of our profit because we had to do like an LLC or a tax return for each one. Plus,
now, what I will say, if you're doing short-term rentals or Airbnbs, I think you should have a different LLC for each one. Those are businesses.
It's a different, and it's a different asset class.
P&L attached to those, right? Like they're totally different deal. But that's a different webinar. This is just single. And I have LLCs.
I put my multifamily separate. So like I will for a multifamily. Like I have a 20-unit building. That's actually we purchased it in one LLC and we're quit claiming it into another LLC. Because of how the money flows, but that'll be set up as a completely separate entity. When you get into multifamily, I would absolutely 100% have your own entity for each building.
Okay. So in our last 5 minutes, before we leave, I want to cover our deal criteria. Okay. So I have a lot of people ask me this. It's like, and here's the thing, here's how it goes, Katie. Like, everyone's like, cap rate, like we were talking about cap rate, cash return, like whatever. I'm like, look, I look at 5 numbers, people. 5
internal
numbers.
Rate of return, IRR.
IRR, I know, all of them, I know. So here's what I look at. Now, again, think of me like a 5-year-old.
Me too. Like, that's the thing, me too.
So what I look at is purchase price, number 1. So acquisition price, number 1. Current value, number 2. Cost of repair is number 4. ARV, after repair value, and then how much I'm going to get rent. 5 things.
That's all I look at. That's how fast it is for me to make a decision.
It's so fast.
And
it's just so fast.
I think, like, I hate to say this, like, I don't know if I want to say men or women or experience versus not experience, whatever. Like, all these investors come to me sometimes like, what's your, on your portfolio, what's the cap rate? And I'm like, I don't freaking know.
I don't know.
Like,
it's single family.
I'm like, here's the deal.
Yeah.
It's worth this. I collect this much in rent.
I will say Ben Kinney has gotten me, like, I have changed my tune a little bit on cash return.
No, I love cash on cash return.
He's giving me pressure in a good way on it. Like, I don't mean bad pressure, but he's like, look, you need to look at how long it's going to take you to recoup your cash. And I was not looking at that. And he's right, because now I'm feeling it because I'm low on cash.
Right. And so, for example, I look at my cash on cash return, like how I view my portfolio, because I was having a panic attack the other day. I was like, oh my God, I have all this money on a line of credit. And Frank's like, that's like 2 houses, like paying cash for 2 houses. Like, and look at what you got for that cash. Yeah. And I was like, oh my God, like, you're right. So technically, like, to be completely transparent and honest, like, cause I didn't have cash, I basically put money on a credit card, and it was $500,000 on mistakes, which I made mistakes in the beginning. Like, I could write a book on the mistakes I made. I don't think a lot of people, but I was also moving really fast, COVID happened, and there were some issues that happened with COVID and losing money on deals and things like that. But when I look at that $500,000, that's basically my cash that I have in, because I've paid back my marketing budget with every deal I've done. So like that money gets paid back. I look at the cash on cash return, like, so that the equity in the houses that I have, that I purchased, is about $5 million. So I spent $500,000 to get $5 million in equity and secure over $1 million. Basically, my portfolio now, we're almost at $1 million a year in passive income once it's all paid off.
Yeah, exactly. Yeah. So you have.
So I'll take that all day long. When I look at
$10 million portfolio, is that?
No.
Did I do the math right? No.
I think we're at mine personally. I'm just talking about mine personally. In Omaha, I think it's like at 13 million.
Okay.
I'll have to look. I haven't done my ARVs in a while. I don't
that's okay. We're out of time. I don't know if it's going to be that exciting for you all, but Robin seems to think I should offer to you my deal spreadsheet, which I want to prep you and warn you, it is not very sophisticated, but anyway, I'm going to share that. So if you want to get on Ben Kinney agent training, you can download it. It's a Google sheet, and I'll copy it and make a blank one for you. And maybe you should see it, because it is so simple. Like, it is not complicated. It's just a whole bunch of columns with all the data I need. And there's a bunch of us have access to that. So you can fill it in, and you'll see on the top, it's acquisition. Well, you won't see, because I'm not going to give you my filled out one, but the top is acquisitions we already have. And then under consideration, we have a segment for under consideration. And then we just cut those and then paste them up top, right?
Yeah. So and that's what I use. Like, that's kind of what I use to make a decision to purchase. But then it gets a way more detailed as after you've purchased, and like we dive into numbers like after that fact. But we're not there yet. I'm sure we'll get there.
And again, we're property managing in-house too. But my husband is a property manager, granted, but we're how many states away? I mean, Seattle, Washington to Tulsa, Oklahoma is far. And
you can't just drive. You can't pop down.
You can't pop down there. I went there once. So we did go on a scout. I've had a couple of people ask me this. We did go on a scouting trip, and let me tell you about that trip, people. Okay. We landed in Tulsa, and Ben goes, okay, that's my husband's name, Ben. And he goes, well, okay, what's the itinerary? I'm like, I don't know. He's like, what do you mean? I'm like, we're just going to drive around Tulsa. And you go, Vija? I'm like, no, really. So all it is, we drive around. I got on like Redfin and Zillow, and I just started looking at all these houses for sale, writing down neighborhoods. I wanted to see what cars were in the driveway, what did people look like who were walking around, whatever. And then we were driving down the road, true story. We're driving down the road, and I see this for rent sign, right? And I see this guy working in there. So I go, pull over. My husband's like, why? Okay. So he pulls over, and I hop out of the car. He's like, where are you going? And I was like, I'm going to go in there because I see someone in there. And so I knocked on the door. I go, hi, I see you have a for rent sign. And he said, yes. And I said, that's great. Can I take a look around? And I did. And I said, do you own this house? He said, yeah. And I go, how many houses do you own? He was an investor. Husband comes in by now because he's like, my wife's in some stranger's house, like with some guy. Anyway, this man is our inspector. He's introduced us to all of our contractors. Him and my husband talk and text all the time. He's so trustworthy. We love him. Like, it was so random, right? And so by driving around now, every time we see an acquisition, they send us video and everything. Yeah. I'll go, oh, Ben, that was that one neighborhood that had that one.
I totally recommend visiting, visit where you're going to buy, so you know what's going on.
Yeah. Well, thank you, Katy. I know I can tell your door's opening. I can see it. I can see little teeny.
Your Frank, say hi. No, that's actually the husband.
The husband?
Yes, you can stick your head in and say hello.
So I want to thank you for joining us today. We went a little over because there was so much. What else is new? You and I we could do a 5-hour podcast. Right. We should do a podcast. That'd be kind of fun.
Oh my gosh.
So thank you so much. Where can anybody get a hold of you if they want to get a hold of you?
Katy, I'm on katyandfrank.com is our website. Katy and Frank, but I think Frank actually has it set up. So if you write Katy, Katie, it actually goes there too.
Got it. Okay.
katyandfrank.com. And if any calls come through there or any emails, the team will actually get it over to me, but it's way better to go through them than to email me personally because my emails get lost at this point. Awesome. So they make sure I get back to people.
You can get me on, I'm so easy to get. I'm via@place.com. V as in Victor, IJA at place.com. I'm always around to answer questions or talk to any of you guys. You know that.
Sometimes Facebook Messenger, if you find me on Facebook Messenger, Katy Klesitz, sometimes that's real easy for me to get back to. Email, it gets lost right now. Okay. So I have 1,000 emails a day.
I know. I feel that so much. Well, thank you, everybody. I hope that you got something out of it. And what I really hope is that, some of you, this excites you like it excited me when I first heard it. I really hope that this sparked some kind of a fire in some of you, right? So we will see you guys next week, which is Wednesday, noon Pacific time. We are always on YouTube on the Ben Kinney channel. We're under the playlist. I think it's called Agent Training Playlist. So we're going to get all this rebranded and start throwing some of these down on podcasts one of these days, but everyone's busy. What can I say? We're buying properties. All right, everybody. Thank you. Have a great day.